For years, IAS 1 has been the global blueprint for presenting financial statements, ensuring consistency and comparability. It covers the four main reports: statement of financial position, profit or loss, and other comprehensive income, cash flows, and changes in equity. But as business evolves, so must the rules. Enter IFRS 18, a major update from the IASB, set to replace IAS 1 for annual periods starting January 2027. IFRS 18 isn't a total rewrite, but it's a significant evolution, aimed at making financial statements clearer and more comparable, especially the income statement. Under IAS 1, companies had flexibility, but this led to inconsistencies in key metrics like operating profit, making comparisons tough for investors. IFRS 18 introduces a more standardized structure, ensuring companies report key figures in the same way. Think of it as moving from each football team reporting stats their own way to everyone following the same rulebook, making it easy to see who's really winning. This shift levels the playing field, giving investors clearer, more reliable data. IFRS 18 was created in direct response to investor demands for more comparable and transparent financial statements. Under IAS 1, companies often used their own performance measures, like operating profit or EBIT, calculated in inconsistent ways, confusing users. IFRS 18's mission is to standardize these key subtotals, so operating profit means the same thing across all companies. The standard also brings discipline to alternative performance measures, requiring companies to reconcile custom metrics back to the official figures. This boosts accountability and trust, making it harder for companies to present a misleading picture. Ultimately, IFRS 18 aims to make financial statements clearer, more structured, and more useful for decision-making. It's about building trust and ensuring everyone speaks the same financial language. The biggest change in IFRS 18 is the new mandatory structure for the income statement. Instead of letting companies choose their own presentation, IFRS 18 requires income and expenses to be grouped into three categories: operating, investing, and financing. Operating covers the core business. Investing includes returns from assets not part of the main business. Financing captures costs of funding, like interest. Two new required subtotals, operating profit and profit before financing and income tax, will now appear on every income statement. This standardization means investors can compare companies directly without decoding different reporting styles. For example, a manufacturer's sales and production costs are operating, gains from selling an old factory are investing, and loan interest is financing. The result? A much clearer view of where profits come from and how companies perform at their core business. IFRS 18 makes the income statement a more powerful tool for analysis. IFRS 18's three categories, operating, investing, and financing, bring clarity to the income statement. Operating reflects the main business activities, like sales and production costs for a manufacturer, or subscription fees for a software company. Investing captures returns from assets that generate income independently, such as dividends or gains from selling investments. Financing isolates costs and income from raising capital, like interest on loans or bonds. This separation helps investors see how much profit comes from core operations versus investments or financing decisions. For example, a car maker's sales and manufacturing costs are operating, dividends from stocks are investing, and loan interest is financing. By keeping these categories distinct, IFRS 18 gives a pure view of both business performance and financial strategy. It's a fundamental shift that makes financial statements easier to interpret. Beyond the new income statement structure, IFRS 18 tightens rules on custom performance measures, now called Management Defined Performance Measures, or MPMs. Companies can still present these, but must explain their usefulness, show exactly how they're calculated, and reconcile them to the new standardized subtotals, all in a single note. This transparency makes it easy for investors to see what's included or excluded and judge the quality of the adjustments. No more burying adjustments in different parts of the report. Everything's in one place. IFRS 18 also requires companies to disclose the nature of operating expenses, even if they present them by function, giving analysts deeper insight into costs. These enhanced disclosures help users understand not just what a company spends, but why, enabling better analysis and forecasting. The result is greater accountability and trust in reported numbers. IFRS 18's disclosure requirements are a game changer for transparency. IFRS 18 isn't just for accountants. It benefits everyone who relies on financial statements. For investors, the new structure and mandatory subtotals make comparing companies much easier and more reliable. Companies will need to adapt, but the payoff is clearer communication and greater credibility with stakeholders. Enhanced disclosures around custom metrics empower users to dig deeper and hold management accountable. IFRS 18 strikes a balance, allowing flexibility for useful information, but demanding clarity and context. In short, IFRS 18 promises more intuitive, reliable, and valuable financial statements for all. It's a major step forward in global accounting standards.